Hello, welcome back to this week's market update. Today is Monday, July 7th, 2025, and we'll jump right in. U.S. equities rallied to new all-time highs last week, fueled by progress in trade policy discussions and a stronger than expected June jobs report on Thursday last week. Over the weekend, we also got the passing of President Trump's big, beautiful bill, drawing attention from investors as we start this new week. As of Thursday last week, before the holiday, the Dow Jones Industrial Average posted the strongest gain, up 2.3% last week, followed by the S&P 500 up 1.7% and the Nasdaq Composite up 1.6% last week. Moving along in our week for economic data, we did get a very positive June jobs report on Thursday morning. It showed that the unemployment rate fell to 4.1% in the month, and the economy added 147,000 jobs in June. Much of the job growth came from state and local government hiring, which added a combined 63,000 jobs in June, while we saw federal government employment decline by 7,000 jobs in the month. The healthcare sector also continued its steady expansion with 39,000 jobs, and social assistance roles increasing by 19,000 new jobs in the month, with most other industries seeing little change. Last but not least, average hourly earnings rose 3.7% from a year ago, while the average workweek ticked down slightly to 34.2 hours. Overall, though, the report offered another month of solid labor market data, enough to ease recession concerns in the near term and support some continued market momentum. Before the stronger than expected BLS jobs report was released, preliminary data from ADP earlier on last week painted a weaker picture of the labor market. According to ADP, private employers, which does exclude government jobs, which we saw was a really strong point of the month of June, private employers actually shed 33,000 jobs in June, the first monthly drop since March of 2023. Job losses were concentrated in professional and business services, as well as education and health services, while sectors like leisure and hospitality and manufacturing saw modest gains. Small and medium-sized businesses were hit the hardest, while companies with more than 500 employees actually added jobs in the month. And despite this weak private employment report, we did see markets kind of cheer up towards the end of the week as the BLS jobs report came in much better than expected. Some other economic indicators from last week, we got the ISM Manufacturing and Services Indexes. The ISM Manufacturing Index posted at 49% in June here, marking another month of contraction, but a slight improvement from May's index. Several key components decline with new orders, as well as supplier deliveries, and employment all weakening in the month of June. On the other hand, production rose. We also saw inventories increase and prices move higher, which is an addition to the index. Lastly, we saw both imports and exports increase sharply, both negative, but still a large increase month over month in activity there. Overall, though, the manufacturing sector remains under pressure with ongoing trade policy uncertainty and the risk of a broader U.S. slowdown weighing on the sector. On the services side, we saw the index improve slightly in June, rising from 49.9, just slightly bearish, to 50.8, slightly bullish there, shifting back into expansionary territory and signaling modest growth in the sector. The increase was driven by stronger business activity, a pickup in new orders, and more positive sentiment around inventories. Prices also showed signs of easing slightly compared to the prior month, which contributed to the more favorable reading. Some of the gains were partially offset by contracting employment, mirroring trends that we saw in the ADP jobs report, as well as slower supplier deliveries. Overall, the services sector remains a key source of stability for the U.S. economy. Last but not least, as we head into the third quarter of the year, where are our recession and economic indicators? Well, currently we have 5 bearish indicators, including the ADS, the ISM Manufacturing, the LEI, the Chicago Fed's National Activity Index, as well as the Anxious Index. And then we have 3 neutral, which includes the ISM Services that we just took a look at, the Philadelphia Fed Business Manufacturing Outlook survey, as well as the Employment Trends Index survey, also neutral in the most recent reading. So overall, we do have a fairly negative picture painted by these economic indicators. It's possible that these indicators are becoming less significant in the current environment, or they could be signaling cracks in the economy that the market is not currently looking at, the market is currently overlooking. So, really, what is the outcome? We're not sure. We're still cautiously optimistic with the current data that we have, but some of these leading indicators do point to some bumps potentially ahead. That concludes this week's market update. We really appreciate you tuning in, and we look forward to providing another update to you very, very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.